What's going on, guys? Welcome back to the channel. Hope you all had an amazing holiday season with your family. I hope you got to spend some time with your family, eat some nice food, open some nice gifts, hopefully get what you wanted for Christmas. So today I wanted to talk to you guys a little bit about top stocks that would benefit from the US-China trade deal agreement. As you know, a couple weeks ago, phase 1 of the deal was kind of put into motion, and I just wanted to talk about companies that would benefit from it, okay? So I'm going to give you guys 2 stocks today that are going to benefit greatly from increased US-China trade agreement. Now, the public won't actually have the privilege of reading this trade agreement, which is kind of odd to me. You know, I don't know why the government wouldn't want to be transparent these days. What do they have to hide? Oh yeah, a lot of things. Anyways, now Trump on Twitter was advertising that this is going to be extremely beneficial for U.S. agriculture, in particular farmers. He actually went as far as naming the company John Deere and said how farmers should be buying lots of land and their tractors. So instead of doing the traditional thing and just looking at agriculture companies or the companies that he's named in his tweets, I actually just started looking at companies which have tons of exposure to China, okay? So tons of imports or tons of revenue coming or originating from China themselves, okay? So basically this whole idea stemmed from a CNBC article where they have their own proprietary China trade index with roughly 25 companies which have high amounts of exposure to China. So this index actually featured many of, the behemoth companies, which a lot of you guys have probably heard of: Apple, Nike, Caterpillar. You also have Best Buy in there, Kohl's, and Honeywell. Okay, so I'm not going to recommend the obvious ones here. I went a little bit deeper and looked at companies which you may or may not have heard of before. I know some of you have likely heard of one of them for sure. They're one of the largest semiconductor companies in the world, and they're actually one of the main suppliers to Apple's smartphone chips. They make the semiconductors that power the phone. Okay, so Goldman Sachs has also kind of looked through multiple indexes and done their own research, and also put out companies which have high exposure to China based on their 2018 annual filings. That's 1 year behind now. A lot of the 2019 annual filings are starting to come forward. So for both of these companies that are recommended today, I did scour through the 2019 annual filings, their 10K reports. Basically, Goldman Sachs' list was heavy on chip makers. They had a lot of companies that develop semiconductors like Qorvo, Qualcomm, Micron Technology, Nvidia, Broadcom, and Intel. Just so you guys know, both stocks that I'm recommending today were on Goldman Sachs' list, and only one of them was on CNBC's proprietary China Trade Index. Okay, so without further ado, let's go ahead and get into it. Okay, so first company that I'm recommending here is Qualcomm. Some of you may or may not have heard of it before. I'll get into their relationship with Apple a little bit later on into the video. But basically, they're one of the largest semiconductor companies in the world. They develop and commercialize wireless technology for various industries, including mobile devices, network equipment, broadband, gateway equipment, automobiles, and also consumer electronic devices. So they have 3 main operating segments, which they code QCT, QLT, and QSI. Okay, so QCT is their main one, and historically it's about 60% or greater of their total revenues, and that is their semiconductor business. Okay, so semiconductors are these little chips which you put into phones, and they ultimately power the phone. Licensing, so through their original equipment manufacturers, this is where they license a lot of their technology, and that's one of their smaller segments. And then QSI is their strategic initiatives, typically below 1% of their total revenue. Okay, so in their most recent filing, about 47.8% of their total revenue had come from China exclusively, including Hong Kong, okay? And there's also a good chunk that comes from the surrounding Asian countries, but almost 50% of their revenue does come directly from China. Now, being a semiconductor business, they're obviously going to be heavily dependent on the demand for smartphones, okay? So this is a snippet directly from their 2019 10K. So from October 2018 through September 2019, approximately 1.4 billion smartphones were shipped worldwide, which represented a year-over-year decrease of 4%. Okay, so it's actually on the decline, and that's according to IDC Mobile Phone Tracker 2019 Q3. So smartphone shipments in the calendar year of 2020 are expected to continue the slowdown in smartphone demand that began in September 2019. And that's also expected to materially affect the operating cycle, or pardon me, the replacement cycle of these smartphones, particularly in developed regions such as China. Okay, so that's not really a good piece of news here, okay? But as this is already public information, this is likely and hopefully already priced into the stock. Okay, and like I said earlier, they're one of the main manufacturers of the chips to the iPhone, and as the iPhone is one of the most popular smartphones worldwide, this materially affects their business if Apple does not renew orders with them, okay? So they got into some litigation with Apple recently, and in April 2019, they entered into settlement agreements with Apple and their contract manufacturers to dismiss all outstanding litigation between the parties, okay? So basically, there was tons of lawsuits going on in between. I don't have the specific details on all the lawsuits. All I can tell you is the result of it was essentially they entered into a 6-year global patent license agreement with Apple effective April 1st, 2019. Basically, they recognized licensing revenues of $4.7 billion resulting directly from this settlement, and ongoing for the next 6 years with the option of 8, they will be the exclusive supplier of this chip to Apple, okay? So the increase in revenues from 2018 to 2019, as I just said, was mainly because of that $4.7 billion settlement between Apple and themselves, which also directly contributed to the higher gross margin, okay? So I should be showing you pictures up here of that in a second here. And that's about it for recent news, okay? So you have smartphone demand going down, and you also have the Apple litigation settlements, which was actually favorable for this year for them. And the fact that they have a 6-year agreement with them is also extremely favorable. Okay, so let's go ahead and jump into their ratios. I will put them up on the screen. I'm not sure if they're too small to see here. I might just put my face out of it so you guys can see the whole table. So one thing I have about 6 or 7 notes here that I just want to make note of. These are some common ratios I always look through when doing equity research. Just some basic ratios to look at against their peers and see kind of where they stand, okay? So here's my takeaways from it. So all the chip makers in this comps table are near the top of their 52-week range, and for those of you who follow investments or the market in general, you'll know that the market rallied almost 20% this year, so it's been an extremely good year for stocks. Looking at their EPS, their earnings per share, they're right in the middle of the pack, okay? They're also in the middle of the pack with their trailing 12-month and forward price to earnings ratio. Again, the price to earnings ratio is something you just look at and you compare against their peers to see if they're potentially undervalued in relation to their earnings and their stock price. So the most favorable ratio in regards to Qualcomm is probably their trailing 12-month dividend yield as well as their forward-looking dividend yield. I believe it's about 2.87%, but that's second highest in their peer group, and only about half of the chip makers actually pay a dividend. So one important thing to note too, they are the fourth highest market capitalized company with the third highest EBITDA, okay? So basically they're the fourth largest company, but they have the third largest earnings before interest, tax, depreciation, and amortization. Not a huge deal, but definitely good when looking at the peer group, okay? So the one thing that is kind of alarming is they have the highest price to book ratio by far. You can see it's over 20 there, and most of them average between, I think, 6 and 7, and then they're in the middle of the pack in terms of their price to sales. Overall, the main reason I'm recommending Qualcomm is because of their high exposure to China, and even though smartphone demand is actually on the decline or going to be somewhat flat in the next year, they will benefit from the deployment of 5G technology to all wireless devices. So just in relation to the rest of the chip makers, their ratios are somewhat average. Again, the best thing to look at for them is probably their dividend yield. If you're an income investor, something you're looking at to buy and hold for a long time, this is a blue chip maker, and they pay a decent yield. They have a large presence overseas, and they're one of the largest semiconductor companies in the world. Okay, so that's it for Qualcomm. Let's go ahead and jump into the second one. All right, so the second one is Wynn Resorts. Wynn Resorts is basically a casino and gaming company. They own multiple resorts in Las Vegas as well as Macau, which is an area within China. So they offer a wide range of amenities, included fine dining outlets, premium retail offerings, distinctive entertainment theaters, and large meeting complexes. Okay, so basically they're a resort company and they own casinos. Now, according to this CNBC article, 75% of their revenues are derived from China. Also, after looking through their most recent annual filing, they state that Macau in China is the most attractive opportunity for investment in terms of the gaming industry, and they are also building a casino resort / area in Boston. Okay, so the interesting thing about this company for me is that they're headquartered in Las Vegas, Nevada, but actually majority of their revenues do come from China. Okay, so we have an American company hopefully going to be benefiting from lower tariff and a healthier US-China relationship. So they own 72% of Wynn Macau, which is their casino. Wynn Palace is their main resort in Macau, and then their last segment is Las Vegas. Okay, now just taking a couple snippets from their most recent annual report, I just wanted to kind of compare Macau versus the Las Vegas stats in terms of tourism. So if you look at the tourist arrivals in 2018 to Macau, there was about 35.8 million tourists which arrived, and in 2017 that number was 32.7 million. Okay, so that's a year-over-year increase of 9.8%. Now they directly attribute their increase in revenue of 13.3% to a 9.8% increase in tourists. Okay. Now, if you look at the difference between Macau and Las Vegas, so the revenues in Las Vegas from 2017 to 2018 actually decreased from 6.5 billion to 6.6. The overall Las Vegas visitor volume was 42.1 million. In 2018, and if you just compare and contrast that with Macau had about 37.5, which I just mentioned previously. Now, the one positive thing about Las Vegas is that their average daily room rate and revenue per available room on the Las Vegas Strip increased by 1.2 and 0.6% respectively. Other than that, all the stats here are actually negative on Las Vegas. So the next one, occupancy on the Las Vegas Strip slightly decreased 0.5%. to 89.5% from 90% in 2017. Okay, and also convention attendees decreased 2.2% in 2018. Basically, Macau is trending upwards and Las Vegas is trending downwards. Even though Las Vegas actually has a higher amount of visitors per year, Macau is more profitable for them, which is why they're focusing on it. Okay, the most recent news, probably most recent relevant news with this company is the CEO, owner, and founder, Mr. Wynn. He's actually been accused of sexual misconduct, sexual assault by many of his employees, and he came to a settlement with the company in February 2019 and actually paid out about $20 million to his accusers. Okay, so since then, he's been distancing himself from the company. He is no longer the CEO. He's not on the board. He's trying to stay as far away from the company as possible. But this is something that could loom over the company for longer than expected, okay? So they don't have his experience and expertise in senior management, and it's also a very negative headline, something that you don't want to see for a company like this. Okay, so since 2013, this company has underperformed both the S&P 500 index and the Dow Jones US Gambling Index, which is not very good, okay? So let's just go ahead and jump into the ratios. Okay, so the first thing that I noticed is that nearly all of these casinos are near the upper tier or upper half of their 52-week range. Like I mentioned earlier, the market had rallied about nearly 20% this year. There's actually only two casinos which aren't in the upper half, and that was Century Casinos and Blue Green Vacations. Now, one real positive for Wynn Resorts was that they had the absolute highest trailing 12-month EPS by a long shot. Their trailing 12-month and forward-looking price-to-earnings ratio kind of gave conflicting signals. So their trailing 12-month PE is in the bottom third, while their forward-looking PE is in the top third, but just keep in mind the forward-looking PE is an estimation. Now, half these casinos pay a dividend. Wynn Resorts, again, is kind of in the middle of the pack in terms of all the casinos that pay the dividend. It's near that 2.5, 2.8%. But again, something that might be attractive to income investors if you're willing to hold this for a long period of time. So Wynn Resorts was the third largest casino by market cap, only behind MGM and Las Vegas Sands, which are massive companies if you know who they are. Okay, so they had the third largest market cap, but were fourth in terms of EBITDA. Not good to see. You usually want to see that either on par or higher than their market cap, especially in their peer group. And they also had the third largest price to book and a middle of the pack price to sales ratio. So overall, I'm recommending this stock again because of their massive exposure to China. About 75% of their revenue is derived from China. They have somewhat of an attractive dividend yield if you're an income investor, if that's something that you're looking for. And Mr. Wynn is distancing himself from the company. So since he's paid out or come to an agreement in the lawsuit, the stock since February 2019 is actually up about 6%. So check out these companies. Let me know what you think in the comments. These are two that I expect to benefit greatly from an increased US-China trade deal. But again, just as a disclaimer, don't forget to do your own research before you invest your money in the stock market. So as usual, guys, I hope you enjoyed the video. If you did, don't forget to give the video the thumbs up, subscribe to the channel if you aren't already, and share the video if you learned something, okay? So hope you guys all have a wonderful new year, and I'll see you guys in the next video. Peace out.